Hi, everybody. Welcome to today's special live webinar event. I'm Terry Ryder, founder of hotspotting.com.au. Today, I'm stepping a little bit outside of my comfort zone. We're talking about commercial property. Happily, I have with us today as our special guest presenter, one of Australia's leading experts in that field, Steve Palise of Palise Property, successful investor, author of a couple of books, with a third one in the works, and one of the most acknowledged leading experts on the field of investing in types of property other than residential. Steve, welcome.
Thanks, Terry. I like that you said happily, like I'm pointing a gun under the table at you, like make sure you're happy that you're here.
Yes. No, delighted to have you here, firstly, because I know it's a topic that more and more people interested in real estate investment want to know about commercial. A lot of people start out perhaps with residential property, but get to the point more and more where they perhaps a little bit bored or wanting a little bit more than sort of passive residential investment. And so we are certainly detecting growing interest in commercial types of property. Are you finding that?
Yeah, so the main biggest driver at the moment is actually interest rates. When most like everyday mum and dad investor look at a residential and they see how much the holding costs are, they still want to buy property, but they're limited on their serviceability, how many they can have. Whereas with commercial, because you get 3 times the cash flow, all of a sudden you can push the envelope a bit further if you want to buy another 1 or 2 properties. And then commercial also offers different types of loans. So you can get based on the actual loan. The loan is based on the property itself. So you can get a thing called a lease stock loan. So where conventional investing stops, if you want to be aggressive and keep going, commercial offers another option. But as you mentioned, just actually getting some passive income from your investment as well. It's a lot easier to do that when you get 3 times the rent.
So higher rental yields in times of high interest rates is part of the motivation, but also there's other reasons, greater flexibility.
I think the biggest reason is actually more awareness, the higher education about it. So five years ago, there was no books on the market. There was definitely no podcasts about it. Now it's becoming more well known as well. So you're getting a big shift of the residential market of just people being educated about it come into it, which can change the dial as well.
Yeah, okay. So one of the topics we're going to cover today is talking about some of the trends in commercial property. And of course, there's so many different types. When we say commercial real estate, we're talking about industrial, we're talking about retail, we're talking about office, accommodation related. There's all sorts of types of real estate.
There's special cinemas, car wash stations, things like that. But most everyday investor will focus on either office, retail, or industrial. Retail, I always hesitate when I say retail because people think when I say retail, I'm talking about a Westfield shopping centre. Most people can't buy Westfield shopping centre, but that's also a misconception as well. I constantly talk to people, and I had a chat with a very prolific real estate agent of Australia, and he said, I'm not going to buy a retail property because retail spending's down. And I'm like, you're not buying a Westfields, mate. You're buying like a medical centre or a cafe or something like that. So that should have nothing to do with it. But again, it gets encapsulated when people say retail. They think the big macro retail numbers is what they should be looking at. But we can have a chat about that today because it all comes down to obviously the residential market as well.
Oh, let's sort of break down some of the basics about the different types, the most common types. You've touched a little bit on retail. What about industrial property? That sounds like massive warehouses, the Amazons of this world, but not necessarily so.
No, you've still got the full spectrum of like service-based businesses, like mechanics, fabricators, wholesalers, distributors, panel beaters, storage. You've got all those as well. And they don't have to be big. They can be the small little body corporate warehouses. You don't have to go really, really large with it. That's having a good time at the moment because vacancy rates have really come down. 3-4 years ago, they were around 7%. Now we're talking typically less than 1.2% in some capital cities. So almost as tight as residential, and you get 3 times the return that way. So that's good there. One of the big drivers for that was actually to see e-commerce boom as well. Everyone's getting things delivered. So a lot of the small goods are now going into things for fast delivery. Yeah. One of the days we used to get excited when your item arrived 5 days later. Now I go on Amazon, and if it's not there the next day, you're kind of like, where's my item? So they need, I call them satellite industrial. So they need lots of little ones to be able to get goods fast to you.
Office property?
Office vacancy rates have shot up. I think the best one we've got at the moment is about 14% in Canberra. The rest of them are 17% plus, for obvious reasons with the pandemic and the work from home culture. But even prior to COVID, like I wasn't a huge fan of office space, similar to residential. I don't like high density apartments because you've got infinite sky space. You can always build up, but you want that land component to get the supply and demand right. So I've always stayed away from office space.
Okay. I know that we did another webinar together with another guest where we're talking about service station property and how that's evolved and what the future of that might be. That's an interesting one.
That surprised me. I actually got so much feedback for that episode because on the whole, I'm not a huge fan of service stations in metropolitan areas.
But regional.
But regional, yeah, that's what we explored on that podcast. Regionally, they actually be really, really low risk because the future of electric cars and accessibility to that is 20, 30 years away. So we can still make our money in the short term. But where the suburban ones are where there's just oversupply. And if there is a shift, if there is a shift to electric vehicles, then there's going to be an oversupply of that. And it doesn't have to go up by much. If it goes up by 50%, then 50% of petrol stations are sitting there vacant and they'd have to repurpose. And then there's a lot of things about, they'll become like a little gym or this and that. But you don't need to have a petrol station to do that. You can put in charging stations almost anywhere. So it's getting the right infrastructure to those metropolitan areres to actually suit the demand for the cars.
Am I correct in my perception that in non-residential real estate investment, it's almost the case that there's something for everybody, all sorts of budgets from quite low right up to the big boys who buy the big shopping centres.
Yes, that's good. There's a big misconception is you need a lot of dollars to get into it, but you can buy a car spot in a CBD for $50,000. I don't recommend it because that's a very one-dimensional kind of asset class. However, I've had clients that go to the city still 3-4 times a week, and they've actually worked out they can buy the car spot and have it paid off in 3 or 4 years. So long-term is actually a good investment for them. But I always try to buy something with versatility and tight vacancy rates. Typically, capital city, you're looking 300, 400 grand in like a Brisbane or a Perth. You can get a small 100 or 150 square meter warehouse. All budgets. Typically, what happens as you move up in price, you start getting longer leases, you start getting bigger premises. And then when you shift into, say, the 1.5 to 3 mil kind of price point, you start maybe looking at freehold properties as opposed to body corporate. Then if you start going a bit higher than that, you start looking at different types of assets like multi-tenancy, more value add, diverse incomes, residential commercial with residential on top. So you get more variety as your price point increases.
Okay. I think it's fair to say that the big interest point for a lot of people is the income that can be generated, the superior yields. Give us some of the numbers to illustrate just how good that can be if you get it right.
It's funny, so that's why most people shift to commercial. However, I still buy commercial for capital growth because that's where you make your big ROI. To answer your question, typically capital cities for something like an industrial in like a Brisbane or a Sydney, you're talking 5 to 6% net yields. If you go to like Perth, you can achieve 6 to 7%. If you go regional, you can go 7% plus. But I want to emphasize the word net because people get confused when I say 6% net. That's not the same as a gross yield with residential. You've got council rates, water rates, maintenance, insurances, things like that. So all of a sudden, a 4% gross is actually closer to a 2%. Because with commercial, the tenant pays all the outgoings. It actually is a true net yield. So you get $1 million property, you get 60 grand in your bank account every single year that you get to work with. So that's the key difference. But if you can win on both fronts, if you can get 3 times the rent and you can get the same capital growth, then you've actually got a much bigger ROI.
Yeah. Okay. Is there one particular type of non-residential property that does better in terms of what you can produce with yields and cash flow?
At the moment, we're actually buying a lot of a lot of retail. Retail is where we're getting really high yields because of the lack of awareness about what's going on. When I mentioned before about, retail spending down, it's a bit of a sleeping giant. So I personally just bought a little shopping centre in Brisbane in Regent's Park for 3.1 mil. It's got 8 tenants, so 3,500 square metre lot. Houses in that suburb sell for 700 grand. So just breaking it up, the money actually makes sense. But that's because you're always going to need a little medical centre or a hairdresser or a cafe, and it's got a cake store and it's got a laundromat as well. You need those services. So if you're looking for a really good yield, I think there's retail opportunity. If you're a first-time investor and you don't know how to understand things like the vacancy rates and foot traffic and road traffic and how to do a business analysis and look at P&L statements and things like that, then I would probably go industrial because it's just a bit easier to understand. It's 3 concrete tilt-up panels and a roller door.
Yeah. I suppose a lot of people think that, residential property, that's easy. We understand it. We've all lived in a house, hopefully. But commercial might be a little bit daunting for people. They might feel that it's beyond their pay grade. They don't know enough. What should people do to overcome those humps and get started?
You're actually spot on. That it is riskier if you don't know what you're doing. So it's not riskier in regards to vacancy rates or capital growth or what you need to do, but because there's so many more things you can trip up on. I always use, I think I made up this metaphor, but I use the staircase one. With residential, it's like having 3 or 4 steps. You just got to make sure you don't trip on those and you're going to be okay. Commercial, it's the entire staircase. So like our due diligence on commercial, we have to look at everything you look at, Terry, with the residential market, because that influences the commercial. Then you have to look at everything with the actual commercial itself. So you have to do like lease review, contract review, tenant interviews, road and traffic analysis. You need to talk to town planners, vacancy studies, occupancy studies. You check their rental ledgers, you check their P&L statements, like you talk to the owner, like you never talk to an owner on a residential property. So there's so many more layers. It's not hard. They're just extra steps that are involved, and most investors just don't want to do it. Like they want to go on realestate.com, look at the pretty house, make an offer, and that's kind of done. The other thing is you can't just go out and pick a suburb. So like most residential will be like, oh, I like this suburb of Brisbane, and they just trawl realestate.com. You can do that with commercial, but there's not 20 properties coming up every week in the suburb to look at. So you're not going to get much. And then of your price point, say you've got $1 million, there might only be one that comes up each month. So if you miss out on that, you can always think. So you need to be much more borderless and open with commercial. So it is more complicated. And I actually would say that's the biggest risk. The biggest risk is not understanding it. Residential, you still stuff up in residential. As you know,
Absolutely.
people buy, we're in Melbourne at the moment. We walked around, we're talking about the high rise and things like that. People still don't get the fundamentals right, but there's less fundamentals and you can weather the storms long term, assuming you have a tenant. You buy a bad commercial, having a mortgage with 0 income is a lot harder to pill swallow.
Yeah. So one of the ways to mitigate that kind of risk is to have good advice on board, to have a team of people around you who do know. What does your business offer to people who are interested in commercial but feel that they just don't know enough?
Yeah, so as you know, I'm big on education as well. I've got like a book in store. I give all my checklists and things like that away for free. So you can go on the website and get all the due diligence checklists. But in regards to a business, I basically facilitate the whole process. So we work on the strategy with the client, why they're buying commercial in the first place. Then you assess their risk profile to make sure the commercial we're buying actually fits their risk profile. And then we do the whole sourcing side. So we find the deals, negotiate them, do all the due diligence. So the due diligence alone takes around 30, 40 hours, and it's about a 100-page report. And then once we go into conditional on contract, we obviously facilitate like introducing the property managers and the conveyancers and the valuers, basically the whole process. But the crux of what I do is get a good commercial, which is good tenant, long lease, low vacancy rate, region, versatile premises at a decent price. I never say a really, really good price, because if you're buying really well in a hot market, you're doing something wrong. But just making sure, to be honest, bit of an insurance policy to make sure they don't stuff it up.
Okay. For those who came in a little late, I'm Terry Ryder, founder of Hotspotting, and today I'm speaking to Steve Palise of Palise Property about commercial property investment. If you've got any questions that pop up or comments as we go through our discussion today in this live webinar, please type them into the chat box or the live chat segment you should see in front of you, and we'll try and deal with as many of your questions and comments as we can in the time we have available today. Steve, what are some of the standout trends in the non-residential property space at the moment?
So I kind of touched on industrial vacancy rates are tightening. They've softened a little bit of late, so they got down to some areas are 0%. So like I live on the northern beaches of Sydney. The northern beaches industrial vacancy rates are 0%. So there's just no stock at all. So as we discussed before this podcast, there's markets within markets and different regions are doing different things, but general trend for vacancy rates of industrial are quite low. It's softened a little bit at the moment where it's come back up to like 0.7, as I mentioned before. Retail, I always take a breath before I say this with retail, because we can get all the data we want for retail, but it means nothing when actually looking at a deal. So like if I'm buying a medical center in a neighborhood shopping center, what's going on in Brisbane CBD, if you're buying on the outskirts of Brisbane, has nothing to do with it. So the retail numbers there don't apply. Even the adjoining neighborhood centers, if there's one 3 kilometers away, completely different road exposure, foot traffic, road traffic, age of the building, Sometimes you go to these little retail strips and they're bustling, like there's a vibe about them. And then other ones you go and it's a bit of a ghost town. They're all still tenanted. So the tenancy doesn't actually show you the full picture. But that's where I want to be mindful of. If you're buying a retail, you really have to understand the area very well. And what I want to talk to you about today as well, obviously, what the residential market's doing as well, because that's going to be a driver for what's facilitating what's in that retail area.
Yeah. Well, let's talk about that because, as you know, our forte is identifying hotspots for people investing in residential property. And we have particular qualities we look for. We have a particular formula that we follow, what we call our empirical formula. And that's an acronym. Each letter of the word empirical stands for something, E for economy, and there's various aspects of that we look for. But I tend to think that the qualities we look for to identify a good residential property hotspot may apply equally or similarly to commercial property investment. Would that be the case?
Yeah, again, case by case, depending on what type of commercial you're buying. But generally, like if you've got good fundamentals for residential, that fundamental is going to apply to commercial because a lot of the fundamentals you speak about are infrastructure. To support infrastructure, you need things like industrial properties. They're what stores the goods and the machinery and where the workers work out of. So they kind of go hand in hand. And it's a little bit of a chicken and egg situation, and why sometimes the commercial market will be the first to actually get put in. So if they're going to look at growing an area, they'll build a lot of the commercial because they need that to be able to then build the houses. So you can have a larger vacancy rate, then they build the houses, and then the vacancy rate comes off a little bit. And then once the residential properties start getting tenanted and vacancy rates come down, they shift to kind of a service-based business one, the panel beaters and the mechanics, like I mentioned before. So they kind of flow together, but in different ways, depending on what you're buying. Also depends where you're buying as well. So buying an industrial property next to an airport is completely different fundamentals to buying like a retail shopping center in suburbia, or even just a industrial complex that's surrounded by residential. The residential based one is service-based businesses. The ones next to an airport or a major highway are distribution type businesses. So they've got a different infrastructure backing behind them. And that's again, another layer of complexity for commercial. We still have to analyze the residential, but try to tie it up with, okay, what is the purpose of the industrial property? What is it servicing? But more importantly, what's the demand going to be in 10 years' time? So, and that's what I always focus on. And I've heard you say this many times now. You don't actually care what happened in the past or the present. It's about what's coming in the future. And I try to push my clients to that as well. One of the biggest ones I typically argue with them over is if we buy an industrial property, and so that's a little one where it's just got a little tenant on a 3x3 year, 90% of investors focus on who that tenant is. They're like, oh, make sure they sign the next lease. They care about that. The better I buy them, the quicker the tenant actually moves out. Because if the tenant's a really successful business, industrial tenants need more space. So they actually move. So you should be asking, well, how tight is the vacancy that I'm going to get the next tenant? And you'll always have a vacancy, whether it comes in 3, 5, 10 years. That's where the fundamentals of like hotspotting and the data for residential really comes into play.
Well, that also speaks to another one of the aspects we haven't, I don't think we've touched on so far. One of the perhaps benefits of commercial property is that the leases, the tenancy covenant is very different, longer, and perhaps more secure.
Yeah. It again depends what you're buying, but typical leases for most everyday investor, you're talking 3 to 5 years on average if you're buying things. So it is much longer. And then you also get good security for it as well. You can get personal guarantees, bank guarantees, a bond for it as well. And then as we've spoken a lot today about obviously the rental legislations and things coming in, that's pretty much, it's basically Wild West. It's a contract. If the tenant basically breaches the contract, you can change the locks, kick him out. So it's much more business and investor savvy than it is we have to follow rigid rules. There are some exceptions for like the Retail Tenancy Act and things like that, but as a whole, it's basically whatever you want to do. You can make a deal, look however you want, and put a tenant on whatever lease you style you want as well.
Yeah, less likely to be constant changes of legislation like we're seeing in the residential space. Massively pro tenant these days, and happening pretty much in every state and territory. I assume that we're not having so much of that in the commercial space.
They generally stay out of it because it is a free market, because it is looked as a business and it's not a roof over someone's head, even though someone's business might then flow into a roof, but like it's basically business. So we're going to follow the same rules as business and profitability and tax and things like that.
Okay, just going back to the whole concept of hotspots, you touched on airports. I'm always really interested in major airports in all of our major cities and some of our regional centres. What springs up around an airport, I think, sorry, I was thinking most of our cities, the biggest employment zone in the entire city is usually around the airport, not the CBD. It's the airport and everything that springs up around it. It sounds to me like that would be a great place to own some form of commercial property.
It depends where it's in the cycle as well, because you don't want to get in too early where they've built 200 warehouses knowing that an airport's going to come. That's the wrong time. But like you said, if the airport's there and the fundamentals are right, and I always like to buy stuff there where there's scarcity. So if it's completely surrounded by residential, and you can then at least make an educated guess that, okay, in 7 years' time, it's going to be an extra 20 to 30% population in that suburb, that's going to give you an indication the demand might be okay. But new airports is a good long-term strategy, and long-term you'll do all right from it. But with commercial, as I mentioned, because you don't want the large periods of vacancy, that needs to be the risk mitigator.
Yeah. No, you mentioned new airports, and I'm really fascinated by the potentials of the new Western Sydney airport. Just looking at the raw numbers of what's happening there and what's proposed to happen. I mean, it's the biggest undertaking in Australia, I think, since maybe the Snowy Hydro scheme. It's just colossal. And I remember making the comment in another broadcast that in terms of property markets, it's like putting a property market on steroids, putting something like this in the midst of, say, Penrith, Blacktown, Liverpool. What's your view of a greenfield sort of airport? Its potentials and risks.
Yeah, great long-term fundamentals, because obviously having like people be able to come in, infrastructure, you can distribute goods. It's getting in the right time. Like I've had clients now ask me about that airport 5 years ago. So if they got in now, it still hasn't turned sold effectively. So it's about getting in the right time. The other one I always get told about is like Olympics. They go, oh, Olympics is coming to Brisbane. It's going to be great. It's going to have lots of capital growth. That doesn't mean you're going to have capital growth. Look at the 2000 Sydney Olympics. We didn't have any growth until what, 2004?
Well, so that's right. The growth for an Olympics usually happens before the event.
That's right. Because there's a thing. But however, then there's a period of high vacancy rates because they've built too much infrastructure. But you also need that infrastructure to grow an area. So I'm from Western Sydney. I grew up next to Blacktown, like in Wentworthville. So I know that area. But like Sydney Olympic Park, when I used to go there post Olympics, it was ghost town. But now you drive out there and it's a city. You go to Parramatta, but Western Sydney's got 2 million people now. Population of Sydney used to be, 2.2 in the 70s? So you have that infrastructure, you get the roads, you get the buildings, you get the ability, but that's a long-term play. So it depends what your strategy is. If you're trying to play just you're going to buy 1 or 2 investments and you're going to hold it for a long period for retirement, it's an excellent strategy. Same thing for the commercial. But if you're trying to be a bit shorter about it in that 5 to 10 year mindset, I like to buy the non-greenfield sites.
Okay. Well, what about the greenfield residential sites? Quite often developers come along, build lots of houses, create a new suburb, but the support infrastructure is not there. The shops aren't there initially. Is that an opportunity?
Typically, yes, at the right price if there's a lack of supply. However, you can also shoot yourself in the foot, because if you buy a property and it sits there vacant, let's say sits there vacant for a year. For that year, you can't do any other investing because you've got this asset with full debt, no income. So you've kind of shot yourself. So it's going to come down to if the price is right and if it suits your risk profile. So someone like me, I can look at greenfield sites because I actually know what I'm doing and doing the checks. For a first-time investor, I'd probably stay away. I didn't get burnt, but I got close to being burnt. So Box Hill in Sydney's West, I did a duplex there early on. And vacancy rates shot through the roof because I was like, I got the land for a good price. I'll build a duplex. And I watched the vacancy rates. I think go up to about 7.5%. I flicked it and still made a little bit of money, but that had a bad time. Now you go out that way to Sydney's northwest and like Kellyville, Box Hill. It's a city now. Like there's plenty of infrastructure, but that was 10 years ago. So it's all about timing it right and assessing the risk. Greenfields are very hard to do unless you actually know how to talk to town planners and assess future vacancy rates.
Yeah, okay. Just extending that thought a little bit further with the residential property, you basically have two choices of an approach. You can buy an established property or you can build something new from scratch, and there are pros and cons for both. With commercial property, undertaking something from scratch, a new development, is that something that people do, or should novice investors just stick to buying something established?
It depends what you're talking. So like when you're buying new with residential, they're typically talking greenfield. Like with commercial, you can still have they're not greenfield, but you can be already in an established area where they build like a new complex and still do really well. So a lot of like the Gold Coast and Sunshine Coast, they built newer complexes, like industrial complexes. And before they even basically finished built, they were gone up 30%. Whereas there's other ones in residential, you do the greenfield, they don't. They actually go backwards, the valuations come in short. So you can do well on both, but you also need to assess the similar residential, the investor appeal and the owner occupier appeal. I'll always focus on owner occupier appeal for certain types of property like industrial, because if there's businesses that are willing to pay a premium and buy it for themselves, that's an indicator there's a thriving economy, because you don't have hundreds of businesses that can afford an industrial property unless they're doing well. And that's also sometimes the first sign that the market might turn.
Okay. So going back to our theme of hotspots, so are there particular areas that you have been buying yourself and for your clients recently?
Yeah, that's a good question. So we apply around 20 properties a month. I'd say around 60% of them are Brisbane and Perth. Main reason for that is the best bang for buck. So I mentioned my little shopping centre for 3.1 mil, you get an entire shopping centre with 8 tenants. If you go Brisbane or Perth, you're typically looking 6 to 7% net yields, whereas the equivalent in, say, Adelaide, you're getting maybe a 4% net yield. And then it's also more affordable. So you can buy $1 million warehouse. If you spend $2 million, you can get a freestanding or multi-tenancy warehouse. So there's way better bang for buck and ways to mitigate the risk. However, the other 40% we buy, we're typically buying Sydney, Canberra, Adelaide, not so much of late. The yields have sharpened too much. We still buy regional, but it has to have an X factor about it. So it needs to be low risk, because I don't want to, like, again, don't want to throw numbers out, but like generally regional properties have a high vacancy rate. And that's why you also get a higher yield, and it's balancing that right. That's not always true though, because different types of assets, sometimes for retail, the main street of a regional town actually has tighter vacancy rates than CBDs, because CBDs are oversupplied. This thing in a regional town, there's only one main heritage listed main street. Yeah. So the vacancy rates, you can have 50 of them. I've got a place in the Blue Mountains of Sydney. That main street, there's about 200 collective ones. There's only ever 1 or 2 vacancies in the entire street at a time. Whereas you go to Sydney CBD, there's vacancies all over the place in the CBD. So for retail, it can actually be all right. But if I'm buying regional, I want to protect my asset and I want vacancy rates to be tight. If that's not the case, I need to mitigate it another way through multi-tenancy or a really long lease, like getting a medical tenant or a childcare centre, something where I can look at the horizon and say, can I still make my money over the next 10 years and be okay if the tenant leaves?
Okay. You're talking about main streets there, particularly with relation to regional towns and cities. Eat streets, are they a particular concept that is in play with the sort of investment that you do?
What do you mean by eat streets?
Well, streets that are sort of like cafe culture, lots of restaurants and cafes, trendy suburbs.
Most regional towns have sort of become that way. So like another one we bought recently was in Tamworth. The main street of Tamworth, it's pretty much filled now, like you mentioned, with eat streets, with really cool pubs and gastro pubs and cafes, and it's got a bit of a hustling, bustling kind of feel about it.
Yeah.
The other one we like, we buy quite a lot of properties in like Fremantle and areas like that. Again, you got the vibe culture. That's a good indicator, again, from like the residential market. If people are spending money and they want to be there, there's going to be some ripple effect. But if we're talking like retail, again, don't go out and just buy, because I say a suburb, because you can buy one street back and it can be a terrible investment. Vacancy rates can be 5 years. On the main street, it can be 3 months. So you still need to assess each deal case by case.
Yeah. With retail, small retail property, it seems to me, just based on my experience in my hometown and the Sunshine Coast hinterland, how location specific the success or otherwise of businesses are. If you're not in the good spot, you're not going to do well. And at the sort of the far end of the street, so many businesses come and go. It seems you've got to get that.
It's funny, man. So the layout is a huge play as well. So it depends what you're kind of buying. So it's less important if you're buying like a U-shaped retail one where the big car park is in the middle and it's not based on exposure from the road. Because if it's a main road one, you want to be basically perpendicular so you can see the shop. You get the road exposure. Other ones where the car parks is at the end of the strip, the far end, as you walk from the car spot, vacancy rates get higher the further you get away. So that last third, they typically have a vacancy rate about 3 times as much, because people they get lazy. They go to the news agent or the cafe at the start and they don't walk to the end of the strip. The length of the strip obviously can. So configuration foot traffic, road traffic all play a part as well. So as you mentioned, the regional towns, they have typically really long ones, or they're kind of like a U, or they kind of like a smaller block that you walk around. But that's why I mentioned before, go industrial if you don't understand those nuances. Then you really have to understand the area as well. And that's the hardest one. What will actually be a successful business in that location? So there's a lot more moving parts. You almost have to be a business analyst. Like, so even when we look at a deal, we have to do a competition analysis. So if we're buying like a cafe or a medical center, we'll look in the area where other cafes or medical centers could open up and make sure they're not going to be oversupplied. Because if another one opens up and it halves their business, that's going to affect your tenant. So it's almost a partnership with the tenant. You want to make sure they're successful as well, because it'll make you successful.
Yeah. I'm wondering how people do that kind of research. With most of the things you would need to research with residential, provided you're reasonably clued in, the information's all out there. And if you've got the time and the energy, you can gather it all together. Sounds to me like with commercial, you really do need some really strong expert advice to do that kind of thing.
You need people on the ground you trust as well, which is a big one, especially for industrial. You can get away with it a little bit because the numbers paint the picture. So like if I'm buying an industrial property in a complex, I can go on CoreLogic and talk to property managers and sales agents and find out exactly what's sold in that complex, what it sold for per square meter, ones that went vacant, how long they were vacant for, what they rent for per square meter. Then I can go to the adjoining complex and do the exact same thing. So all of a sudden I can build a list of 20, 30 comparables to make an educated decision. Retail, you don't have that luxury. If it's a retail strip with 10 shops, you've got 10 comparables. If none of them being vacant in the last 5 years, what's your vacancy rate? And it actually is a thumb suck. But this is where having people
a thumb suck.
Literally, you have to guess. Like, my example, my little shopping center I bought, I couldn't compare one that was 2 kilometers away because it's got different road exposure, different parking configuration, completely different suburb. I could only look at the history of mine. In the last 10 years, 2 had went vacant, and the longest period of vacancy was about 5 months. So I went, okay, worst case, if I follow that trend, if I lose a tenant, it's going to be around 5-6 months. I'm going to get 7/8 of the rent. And that's how I'm protecting that asset in regards to risk. But where you're buying sight unseen, for instance, you need people on the ground you trust. So you need to have a really good relationship with the property managers who can tell you the good areas, the bad areas, what shops are doing well, where they're located. A building and pest inspector you really trust, and the sales and property managers there. And even a town planner. You don't want to buy something and find that they're going to build another shopping centre a couple streets away and the Woolworths is going to drag all the foot traffic away. So you got to look at the big stuff as well. So all that stuff you can get away with not checking, and you should check, but you can get away with residential. It's not going to kill your investment. A Woolworths probably is actually going to help, whereas something like that might actually take away.
You touched on buying sight unseen, and a lot of residential property investors do that, and you can do that with residential. I do it quite frequently myself. It seems to me, though, if you want to be successful with commercial, it could be smart to actually visit an area and walk the streets and talk to businesses, get to really know the area.
The cool thing with commercial is most of the time you can actually go on a contract subject to due diligence. So you actually get 21 days or so up your sleeve to go inspect it. So you can actually sign a contract and then you get a bit of breathing space to go do it. So like we'll go inspect the property. Because I've been doing this now, I've bought like 2,000 properties. I've got people on the ground who can do it for me. And typically with especially a retail, we'll send 3 people to go look at the property. One's the future property manager because they're going to do it because they're going to get the management if we do go ahead with it. And they know the market, what they lease for. One's our inspector. So we've got a commercial savvy kind of inspector who'll go look around the property, and the building and pest inspector. And then outside of us, a valuer from the bank is also going to look at it. So there's effectively 4, but 3 people we actually trust. I would not be just signing a piece of paper and being like, yep, that's fine. I'll do a desktop kind of check and walk away from it. For retail anyway, like I said, you can probably get away with it for industrial. But again, most people don't understand how to even assess the data. Like residential, there's plenty of websites you can type in and find out a vacancy rate of a 3-bedroom house. That doesn't exist for commercial. There's no website that tells you exactly what the vacancy rate is. You need to go on CoreLogic, click through everyone, look at leasing campaigns, how long they'll lease for, call 2 or 3 property managers and say, cool, what have you had on the books? What's been vacant? How long was it vacant for? And get addresses and actually put timelines to it. There's a bit more grunt work involved. Whereas residential, type it in, bang, fill in the box. Yep, cool, 0.5% vacancy rate, next.
Yeah, okay. Going back to talking about some specific areas, prior to going live, we were talking about areas like lifestyle areas like the Sunshine Coast as good places that you're interested in, particularly now at the moment. And we're certainly interested in the Sunshine Coast because it's a classic, what we call second wind markets from a residential viewpoint. Had great growth in the past, wonderful fundamentals, great future. Right now, the market's in a bit of a pause phase. Great time to be looking at buying residential there. Sunshine Coast is also on your checklist.
Yeah, a lot of the East Coast, surprisingly, for retail. One of the good things about buying a coastal property, especially for the retail, is you've actually got the lack of oversupply because there's water on one side and residential on the other. So if you get the actual beachfront property, you can look at the demand for that property based on what the residential market's going to do. So if they are changing to high density, they're shifting the zoning from low to medium density and they're building more people. Hopefully that'll bring more foot traffic. If it's also a holiday location, you can assess that. So I like retail there. We also mentioned some other areas like Toowoomba and things like that. Those more regional kind of country areas, I like industrial properties because there's what's fundamentally is going to supply basically that up and coming region, and you need warehouses. I'm not saying don't buy retail there. It's just a little bit harder to kind of get the nuances, but I love lifestyle properties. I've got a side rule. So if I go on holidays to an area and I go, that's my first tick of, okay, look into this area. It's got the livability score. Then you've got to back it up with, okay, why is the supply going to tighten or why is the demand going to increase?
Yeah, okay. You touched on Toowoomba, one of my favourite subjects. I really like Toowoomba, taking a long-term view and a short-term view as a place to invest, a really strong regional city. It's got that diversity of economy that we like. It's growing population, ticks a lot of the boxes in our empirical formula. But it's the infrastructure thing that's really important. New airports in place, that must generate demand for commercial property. The inland rail link's coming, that's another one. And plus there's $1 billion hospital to be built. There's a lot happening there that would generate.
It's good proximity to major CBD as well, to Brisbane. It's kind of similar to like a Newcastle was 10 years ago, where like you still can get into Sydney and out of Sydney, but you've got that. But like you said, there's so much infrastructure going on there, it's silly. And I'm even seeing the vacancy rates of industrial. Most properties that come on sale get sold to own occupiers. So as I mentioned before, the people in the local people there have the money and they know what's coming, that they're actually buying it before the investors, which is always a good sign.
Yeah, okay. Just reminding everybody watching and listening, if you've got any questions, type them into the chat box or the, what's the other spot, Tim, yeah. So you can type your questions and Tim, who's sitting there in the background, is going to convey them to us, I hope.
And sign language.
Happy to take your comments and questions. Don't miss this opportunity to put your burning questions to one of Australia's leading experts in commercial property investment. Steve, if one of the things that's really you've brought home to me today is that wonderful opportunities and potentials in commercial property investment, but there's a lot to do. And I certainly wouldn't recommend anyone going it alone with it. How do people educate themselves? And there's a bit of a Dorothy Dix question, because one of the answers I'm looking for is, I know that you've done a wonderful online course, which I think is freely available to people. I think it's a great place for people to start because you take people through all the different aspects, the differences with residential, what you need to know.
Yeah, so I've got the course. If you want to see my face for 10 hours, there's me rabbiting off. Also got a book if you're more of a reader. It's a book I've given away, 25,000 books now, and there's 10,000 people that done the course. So I'm all for education because, like, as long as you're making smart decisions, it's going to be okay a long time. And then I prove my competence through giving out this information for free. But yeah, the main thing is just get educated and actually do the grunt work. That's where most people fall over. Yeah. Most people with residential, well, they want to know the suburb. Then they'll go look online, they'll tick their 3 or 4 boxes and they'll be kind of job done, I'm rich now. Commercial, there's a lot more places to fall over. Yeah. But generally, like, you can actually build a passive income quickly. I don't want to make this like a sales and try to convince people to buy commercial, but like if you buy a $1 million commercial property at a 6% net yield, even with interest rates where they are now, because you have typically a bigger deposit, it's 20, 30% deposit, that property's paid off in around 12 years now. So if it's a 6% yielding property, even without inflation or rental increases, that's a $60,000 passive income. Typically, rents are going to go up probably to $90,000 or $100,000 by then. So in 12 years' time, you can actually have a 6-figure passive income. To get that in residential, you got to buy, $5-6 million worth of residential, and you're going to want to hope the interest rates double. and then it'll probably pay itself off in 20, 25 years. So you can do much more powerful things with commercial in a short period of time. And that's how I basically retired. I got a passive income from buying some good assets. But there's way more places to trip up. So don't just do it thinking it's going to be get rich. Just tick the boxes and do the hard work. Like I mentioned, there's about 30, 40 hours per property you need to do.
Yeah. We haven't actually talked much about finance. I know that's different in terms of residential property. Relatively easy to get a loan to buy a house or an investment property in the residential space, but the parameters are a little bit different for commercial.
So this is probably the only big negative for commercial. The first one was obviously lack of education, but the next one is finance. So residential, the whole reason I like property is leverage. You get to use someone else's money, leverage that money, and then magnify your returns that way. If you're starting out in residential and you're a young investor, you can get 90% loans. You can get 100% loans if you've got parental guarantees and things like that. So with commercial, the most you can get is actually 80% LVR. Most people actually get a 70%. So you need a 30% deposit. Whereas if I'm a new investor, I'm definitely going to go out and buy 3 residential properties on 90% loan to value ratios versus 1 commercial. Because if what I'm saying is right and we get the same capital growth, you're going to have 3 times as much to then leverage into a high yielding asset. So you lose a little bit of the leverage with commercial and there's a lot more skin in the game. If you're buying $1 million asset with 70% LVR, you need 300 grand deposit plus 50 grand purchasing costs. It's 350 grand. It's not chump change. So it's a lot harder to get into the market. So that's generally why a lot of people start in residential and then leverage the growth and equity that they've got to then get into commercial. The other thing that stops them is if serviceability. So as I mentioned before, they're typically negatively geared now with interest rates. You're going to hit your glass ceiling in terms of lending with residential. Commercial, you can get lease stock loans. So as long as the property looks after itself and you can get the deposit, you can effectively infinitely buy because it's as long as it's a positively geared asset, you can just keep going. The hard part is getting the deposit. Getting a 350 grand deposit is the bottleneck now. But yeah, there are key differences. But the same rule applies. You can still get a full doc loan. They still do their servicing criteria where they slap on 1.25 to 3% extra interest rates. They take 20% of the rent off. They do P&I even if it's on interest-only loan. So they still do the same shading. But when you've got a property that's positively geared versus a residential that's negatively geared, you obviously can go better long term.
Okay. Just interested to know how you got started with this. Did you do residential first and then gravitate to it?
Yeah. So I used to be an engineer, design engineer. I used to design robotic limbs, and then I got into mine site design, and then wasn't really happy with the corporate world. So then just kind of wet my toe. I got lucky slash not luck. I read every single book and then bought in the suburb next to where I grew up in Blacktown. And then I got lucky because I bought in 2012, which was the start of the cycle. So bought in 2012 a little house for 230 grand. It went up 100 grand. I was like, this is easy. I'm making lots of money. And then, like you said, I went down the residential route. So I think I had 8 or 9 properties before I bought my first commercial. Yeah. And then same thing. It's because I was looking for a passive income. As interest rates started climbing up, I went, well, I did this to get out of the workforce, not to stay in it. Then I shifted to commercial, and then that kind of opened. That was my light bulb moment. I was like, okay, I can actually get a passive income now.
Yeah. But the comment you made at the beginning was that you primarily buy for capital growth.
Yeah, which most people don't talk about with commercial. But if you look at your ROI, like if I'm not getting capital growth, 6% isn't that attractive anymore. But if you also get 6% capital growth, having an 18 to 25% ROI, that's where the real money comes in. It's also a good indicator for the supply is getting tighter as well if you're getting the capital growth. So I want to win on both fronts. You can still buy properties that don't have as big capital growth if it's a short-term plan. So what I mean by that is, like, we've bought some clients in like the regional areas like Townsville and Rockhampton and areas like that, where you'll buy like a little shopping center, and even though you're not convinced of the fundamentals, you get a 7 to 8% net yield. But that's for normally like a retiree who wants the low risk and the high yield. So it depends what you're buying. But I feel a bit young. So hopefully I've still got another 30, 40 years. I want the capital growth as well.
Okay. So Tim lurking in the background there. Do we have some questions coming in?
We do. The first one we have is for Steve. It's from an anonymous attendee. They asked, I've got a residential property approximately 1,000 metres square in Victoria, located in the suburb of Pakenham. Due to the change in zoning, now it's actually in our activity centre precinct 7. What are your thoughts about Pakenham as a suburb, and what could be done on an activity zone with 1,000 metre square land size?
So we should repeat that question if you feel you. Okay.
Cool. All right. So I won't comment on the suburb as a whole because I don't have the data in front of me. And I actually don't know it that well, but Terry can if you want. But in regards to that, for my part of it, what you can do with it, first thing is actually talk to a town planner and find out what's actually possible. So find out what you can actually do, what activities are actually allowed. Then you can actually go to the market and see, okay, is there an option? The next person I'd talk to is actually some property managers. So go find 2 or 3 good commercial property managers and ask them what's in the most demand at the moment, or do they have anyone interested in this actual location, and then go from there. Sometimes it's actually better left as a residential, but there might be an opportunity where they say, I've actually had a bit of interest in this type of asset. Then you can decide whether you purpose built something to get them in, or approach an actual business first saying, I've got this location. Do you want to kind of get involved somehow where I'll build it and you sign a long lease? So that's the fun and the annoying part of commercial is there's so many unknowns. Whereas residential, you talk to a town planner and they go, oh, you can build 4 townhouses. This is what business do you actually want in there? And are you going to purpose build something? What style's allowed? So there's a few more elements to it, Terry.
Yeah. And in terms of the location, Pakenham, that's part of the local government area, I think, of Cardinia, in the far south east of the Melbourne metro area. Some would call it regional, just getting beyond the greater Melbourne area. Towns like Pakenham, Officer. It's been an area of incredible development of new population. Last time I drove here, there was just a sea of new housing. Amazing sort of numbers of in terms of the growth of population just through the creation of new housing. It would suggest that there are opportunities for residential types, are probably just by weight of the population growth through new housing development. But it was at one point, popular because of the affordability factor. But of course, the cost of building new homes these days has increased. It's not so cheap anymore to build new homes in places like Pakenham and Officer. So perhaps that appeal is starting to dissipate a little bit.
It also depends on what they're trying to achieve. If they're trying to achieve some equity uplift by doing a project, then not necessarily commercial might be the right option. It might actually be a residential development. If they're looking for cash flow, then again, there's second dwellings you can do, or you can actually shift it into commercial. But again, it's going to be case by case. If you want to send me an email to steve@paliseproperty.com and I'll send you some options.
Okay.
Very good. Next question we have is from Andrew, who's asking, are childcare centres still a good investment?
That's actually a really good question. I get asked about that almost every single week. Yes and no. I personally don't like them for a couple of reasons. First one are the yields are actually really tight. And that's actually because there's too many investors that really like them as an asset class. So you're looking at childcare now, a lot of people buying at 4 or 5%. The reason I don't like them though, so they don't have the yield, they're also really one-dimensional. So if that tenant ever moves out, and childcare's fail, people think it's a foolproof thing that, more people are working, things like that. If the childcare fails, you've got a very purpose-built center, which you can't actually do anything with. Like you can't put a warehouse there. It's a very purpose-built, weird residential style type of one. So if you lose that tenant, yes, you're getting a long 5-10 year lease, but if you lose them, you've got an asset that you basically have to knock down and rebuild. So for me, the risk is too great if you're not getting the reward of the actual yield. And that's the hard one. But it depends what type of childcare as well. This is another one. Is some childcares are in office buildings. I wouldn't buy that anyway because there's no land component. Some are actually industrial properties. So you've seen like in the industrial complexes, they've got like the cool big kids rooms and the turfed grass and the slides and all that stuff. That one I don't mind because if the tenant leaves, it's still got the versatility to put in a different style industrial tenant. Yeah. But if it's the purpose-built residential ones, if you don't get it right and you lose that tenant long-term, you're playing with fire.
Yeah. I like your response to so many questions today have been kind of yes and no. Yeah. It depends. Yeah. That's the reality, isn't it? There's no sort of right answer to anything.
Like with residential, if someone says, do you like 3-bedroom houses in a suburb? You can say yes or no. But commercial, like I just mentioned for childcare, like is it office? Is it retail? Is it industrial? Like they change as well. So I used to work in the Westfields Tower in Bondi Junction. There was a childcare on like the 12th floor. So that was completely office building style one. That one I wouldn't touch even if they signed a 10-year lease because I don't like the asset class. It doesn't have a land component. So there's so many kind of like just chops and changes for what you can actually buy and even mixed use, which gets it even more complicated.
Okay. Next question.
Okay, we've got a ripper question here from Natish. It's one for you, Steve. What is the most unorthodox or interesting commercial property you've purchased, and what appealed to you about it?
I'll say two actually. But the first one, we went to buy an industrial property in Perth, but it was a gentleman's club, i.e., wasn't a brothel. It was actually a swingers club. But it was actually an industrial property. And then, so I really like the fundamentals. The vacancy rates are really tight. And I was like, I don't actually care that it's thing. Like, it's not a brothel. They're just swingers that go there and pay their membership. But we actually crashed the deal because the banks didn't like it, so we couldn't get finance. Then we also spoken to an insurance broker, and the insurance companies didn't like it as well. So even though fundamentally that property itself stacked up, ticked all the boxes, it was good location, tight vacancy rate, versatile premises, the tenant and the insurance is what kind of fell over. So that's the funny story type one. The most interesting one was we bought in Sydney. It's a fish and chip shop with a residential on top that had telecommunications on top and an ATM machine down in the shop. So they had a lot of different tenants.
What kind of zoning covers that?
Mixed use, I suppose. So that was in Mortlake. So yeah, so that stuff like that, and that shows the creativity. We've got quite a lot where we buy like industrial retail and you get telecommunications on top as well. So you get like 10-year Optus contracts and they pay you quite a lot. We bought one in Perth. They got $1 million up front for a 10-year lease. So it didn't affect them. So you get that creativity as well, whereas you can't really do that with residential.
Sure. Okay.
This is a follow-up question to one before, Steve, just a quick one. Is it expensive to get the town planner advice?
Not the initial conversation. So there's two people you can talk to. You can obviously talk to the council, which they'll give you the fairly, don't hold us to anything, but this is what you maybe can do. Then you talk to a private one. I personally like the private ones because I think if it does go ahead, they're actually going to get the business of actually doing it. So the initial conversation's free. So you don't pay for anything until you want to go down the rabbit hole a bit more, and then you can stage it. So just make the phone call. You'd actually be surprised. They do it all day, every day. Most of the time they can tell you off the top of their head.
Very good. We've got one here from Kelly. Steve, I saw that you have offered your property course for free in the past. Is this still available?
Yeah, still available.
I believe it is. I will drop the details into the chat in case anybody who's listening is interested. Use the code word hotspotting and you will get a discount.
Discount 100%.
100% discount. We've got one from George. We probably need to wrap things up shortly, but we've got time for one or two more. George has asked, what is the best way to source commercial property apart from checking realcommercial.com.au?
Yeah, so we actually get around 60-70% of our stuff off market. And I don't like using the word off market because people think it means below market value. It just means we get access to it before the public do. Obviously, if we don't pay the right price, it's going to go onto the market anyway. But most agents like working with us because if we do find an issue, which we do, like most of the time we find something's not right with it, we actually don't just crash the deal. We actually know how to fix it. If the mezzanine's not approved, we know how to get a certifier and do council approvals and things like that. So they work with us that way. But sort of answer that question is talk to property managers and selling agents, even property managers actually. They're your source of information. Become friends with them. My other piece of advice is when you are talking to them, don't lowball. They'll put you in the too hard basket. Only make reasonable offers and talk to them like they're an actual person.
Very good. We're going to finish with one for Terry. Terry, when will we start seeing some hotspotting reports on commercial real estate?
Well, I think one of the points we made today is that we're already publishing hotspotting reports for commercial. It's just that they're focused on residential. But I think one of the themes of today's discussion is that the same principles apply. If an area is a great place to buy residential, there's a pretty good chance it's also a pretty good place to have a look for commercial property. We touched on that, and we've had that discussion before a number of times. Steve, you tend to agree with that.
Yeah, pretty much all the areas I've seen where there's been residential growth in the last 10 years, there's been commercial growth of equivalent value. And it almost has to, because you can't afford rent in an area and then not afford the commercial rent if it's moving at the same time. So you don't have a $1 million house go to $2 million and then the $500,000 warehouse stays at $500,000. So they are interlocked. Whether or not they're in the exact same cycle is the hard question.
The cycle is the key thing to have a look at. Well, we're actually coming up almost to the hour, and probably a good time to start wrapping things up. Steve, I feel like we've covered a lot of territory today, but I also feel like we've only scratched the surface because there is so much to know and so much to talk about. For people out there who've got a bit of a taste for it and want to know more and want to follow up, what can they do and how can they get in touch?
Yep. So I've got the course, which is the commercialpropertyinstitute.com. There's 10 hours there. And like you said, I've just scratched the surface. So I actually recorded 40 hours for that course. And my social media team said, no one's going to watch you for 40 hours, Steve. Cut it down to 10. So keep an eye on that. There will be new modules going on YouTube and on the course. But then if you want my book as well, go to paliseproperty.com. And then if you send an info inquiry there or shoot me a direct email, steve@paliseproperty.com.
Okay. And just repeating something I mentioned in the intro that Steve has published 2 books, one on residential, one on commercial, and there's a third book in the works that's on development.
Yeah. So I want to give people the full picture. Because I didn't want to write a residential book. I wrote the commercial one, and then I actually got sick of people thinking I was just trying to buy commercial for them. But I'm a huge advocate for residential. Like, it's what got me to where I am. I've purchased 1,200 plus residential properties. So I begrudgingly wrote another book, the residential one, just to show people, hey, there's pros and cons of each. Now I'm going to close out the trilogy and say, hey, look, if you want to make money a bit quicker, there's development, but here's the risks as well.
Yeah, and it brings us back to a theme that I constantly espouse for people. There's no one right answer to me. I keep getting asked, where's the best place to buy? Well, there's no answer to that question. It depends on the individual and so many aspects of who they are, what they own, etc.
My 3 questions I ask every client is, what are you trying to achieve? Over what time frame? Versus what do you have to work with finance? And then you try to amalgamate all those, and that's where you start picking the suburbs.
Okay. All right. Good way to wrap up today, I think. Anybody wants to find out more, I do urge you to make contact with Steve Palise of Palise Property. Just tell us again how they can do that.
Go to my website, paliseproperty.com, or shoot me an email direct, steve@paliseproperty.com.
And I think that's also been put in the chat box, so you can see that there in front of you, hopefully right now. But I do urge you to follow up. There's a lot to know, but if you're willing to take the time to go on that learning curve, the potentials to gain over time, I think, are tremendous in terms of passive income and also capital growth. Thanks for being part of it. Thank you, Steve. It's always fun talking to you.
Thanks, Terry.
And let's do it again soon.
Yeah, let's do it.
Okay.
Thanks, Terry.
All right. Bye for now.